Hey, welcome to Modern Investing Techniques, episode 29 for April 28th, 2026. I'm Patrick, coming to you from Vancouver. Let's find the signal in today's noise and put your portfolio to work. Quick reminder, everything we discuss here is for education and entertainment. The practice investment of the day uses simulated trades with no real money. I'm not a licensed financial advisor, and this is not financial advice. Always do your own research before putting real money to work. Oil tops $110 on stalled Iran talks, while Clean Power Eyes records, despite policy risks, two signals demanding disciplined positioning. This morning, the markets traded mixed. The S&P 500 closed at 7,174 for a gain of 0.1%. The NASDAQ Composite reached 24,887 with a gain of 0.2%. The TSX Composite finished at 33,818 after declining 0.3%. Geopolitical developments around Iran are dominating sentiment. These forces are lifting Brent crude above $110 while creating choppiness across equities and raising input costs elsewhere. Our simulated portfolio sits at year-to-date negative 0.52% versus the NASDAQ Composite's year-to-date gain of 7.11%. This produces alpha of negative 7.63% year-to-date and negative 11.75% since inception. We need a good week here. Like our TMUS relative value rotation 2 weeks ago that eked out modest positive alpha by focusing on resilient United States telecom risk reward, today's setups reward similar patience over reaction. While the indices are relatively quiet, the underlying forces creating this chop are exactly what our strategy spotlight was built for today. Choppy market stock selection is a disciplined process. It focuses on identifying companies with durable competitive advantages. Those companies also show low leverage and consistent earnings power. This enables them to outperform during periods of elevated volatility. Today's conditions make the approach highly relevant. Geopolitical tensions are driving oil above $110. The same tensions are pressuring European margins and creating uneven sector performance. This is exactly the environment where broad indices wobble but quality names hold or advance. To implement the strategy, screen for stocks showing beta below 0.8. Also require debt to equity under 1.0. Look for at least 3 years of positive free cash flow growth. You can use free or brokerage tools for this screen. Cross-reference with recent earnings consistency. This approach has historically worked best during macro uncertainty such as 2022's inflation shock. It limits drawdowns versus the NASDAQ while still capturing eventual recovery. Risks include opportunity cost during strong momentum rallies. The strategy also requires ongoing monitoring to avoid value traps. The key action is to build a short list of 8 to 10 such names now. Size them at 4 to 6% each in your TFSA or RRSP. Deploy only on pullbacks to their 50-day moving average. This disciplined approach is useless without ironclad risk management, which leads directly into today's investor education. This is a simulated trade for educational purposes only. No real money is involved, and this is not financial advice. Today's practice investment is in verification mode with no new position. We are monitoring oil and energy for a sustainable move. The sector is commodity focused, and the strategy is geopolitical premium assessment requiring multi-source confirmation. The catalyst is reports that Trump is unhappy with Iran's latest proposal to end the war. This is driving Brent crude above $110. On the technical side, prices have broken above the $100 psychological level on daily charts with volume above recent averages. However, the weekly RSI is elevated. Risk assessment shows sudden negotiation progress could trigger a 10 to 15% reversal in energy. Any eventual equity position would be sized to risk no more than 1% of total capital with a stop 8% below entry. The target remains not applicable until confirmation. Confidence level is low because multiple independent reports align on tension. Yet resolution uncertainty plus the need to verify data availability from multiple providers keeps us on the sidelines. This no trade demonstrates the discipline of patience in high uncertainty environments like current Middle East developments. Listeners should learn that avoiding a marginal setup preserves capital for higher conviction ideas, especially when our process requires cross-verification that is not fully satisfied today. This exact discipline is why we are sitting on the sidelines in energy right now. We stayed disciplined today, but yesterday's flash trade did not go our way. Here is what happened and the rule we are adding. Last flash trade was CLDX on an analyst upgrade play. It was based on successful phase 3 results and accelerated enrollment. Entry was at $35.79 at market open. Exit was at $34.38 at market close. The result was a loss of 3.94% or $39.40 on a $1,000 position. The NASDAQ gained 0.2% in the same session, producing approximately negative 4.14% alpha. Positive phase 3 news was already priced in. Sector momentum was absent despite the confirmed catalyst. This reinforces the process gap we keep encountering with binary events. It highlights the critical need for multi-source verification to judge true alpha versus the NASDAQ. New rule: always verify data availability from multiple providers before declaring a weekly hold closed. The tools below can help you run those multi-source checks faster and spot the setups the market has not fully priced. FinViz delivers real-time charts, fundamentals, aggregated news, and technical scanners in one free interface. It lets you instantly filter for RSI below 30. You can also screen price relative to 50 and 200-day moving averages or volume surges. Canadian investors gain an edge by running combined TSX and NASDAQ screens in under 60 seconds. This spots emerging setups before they appear in mainstream alerts. The free tier is more than enough for daily use. Log on at finviz.com each morning as part of your pre-market routine. Community templates in Google Sheets let you input your own free cash flow growth assumptions between 9 and 15%. You also set WACC around 9% and terminal rates at 2.5%. This tests whether a stock is actually 20% or more above fair value. The technique removes reliance on sell-side targets. It is ideal for TFSA and RRSP holdings where you want to validate long-term dividend compound annual growth rate above 11% before committing capital. Download free Google Drive versions, adjust the bear base and bull cases, run reverse discounted cash flow to see exactly what growth rate the current price requires. Update quarterly after earnings. Prime Minister Mark Carney promises good news in the Spring Economic Update. The federal government will table its Spring Economic Update Tuesday afternoon. The Prime Minister is highlighting the Liberals' record as good fiscal managers. For Canadian investors, this creates potential tailwinds for domestic growth sectors and tax-advantaged accounts. Review your TFSA and FHSA Canadian equity holdings for any rebalancing needs before the Tuesday release. A family-owned personal protective equipment producer warns of impending shortages and price increases for oil-derived everyday goods. This stems from Strait of Hormuz disruptions. It is a second-order inflation effect that can pressure consumer margins and spending patterns. Add a modest inflation hedge sleeve, commodity, or real asset exchange-traded fund to your RRSP if current exposure is below 10%. After reports of OpenAI missing targets, one company saw its worst share price decline in 6 months. SoftBank shares suffered their largest single-day percentage drop in 6 months. The move highlights how quickly artificial intelligence-related valuations can reset on fundamentals. Trim any artificial intelligence adjacent name exceeding 8% of portfolio weight to enforce concentration limits. United States clean energy installations are projected to reach another record. This comprises the vast majority of new power additions despite policy headwinds from the current administration. Add a clean energy or utilities exchange-traded fund to your watch list for evaluation on any weakness over the next 30 days. Now let us look at portfolio performance on these simulated trades of $1,000 each. Total trades stand at 8. Win rate is 38% with 3 wins, 4 losses, and 1 break even. Cumulative profit and loss is negative $41.56. Average return per trade is negative 0.52%. Best trade was positive 7.88%. Worst trade was negative 7.49%. Current streak is 1 loss. Our artificial intelligence analysis is learning from these patterns and adjusting. This remains a learning journey where we track real outcomes against the NASDAQ. Imagine you bought an energy-related name last week when oil first spiked on Iran news. You allocated 12% of your $50,000 TFSA because it felt like a sure geopolitical play. Your order filled at market, but a follow-up proposal headline triggered an immediate 9% gap lower, suddenly $540 or 1.08% of the entire account, vanished in one session. Position sizing caps any single name at 5% of total capital. That way, even an 8% adverse move costs the portfolio only 0.4%. Stop losses fixed at 7 to 10% below entry or trailing based on 14-day average true range automate exits before small losses compound. The simplified Kelly criterion further refines this. Position size equals win probability times payoff ratio minus loss probability divided by payoff ratio. Even a conservative 0.25 times Kelly on a 55% win rate strategy prevents overbetting during emotional conviction moments. Correlation matters too because 3 energy names at 5% each still act like a 12% sector bet if oil correlation exceeds 0.7. Portfolio drawdowns above 15% historically take 18 to 24 months to recover. Professionals always calculate the exact dollar risk, account size times 1% maximum loss, before they choose position size or stop level, never the reverse. The biggest mistake with risk management is treating high conviction ideas as unlimited bets, or moving stops farther away as a position goes against you. Instead, always define your maximum portfolio loss first, then let the math dictate the share count. Open your brokerage account right now and calculate the portfolio impact if your single largest holding dropped 10% tomorrow. If that loss would exceed 2% of total capital, reduce the position this week to align with the 5% maximum sizing rule we covered. It takes under 10 minutes and builds the exact habit we discussed in risk management. Before we wrap, I have my eye on something in the energy sector for when multi-source confirmation lines up more clearly. That wraps up today's modern investing techniques. Remember, every trade is a learning opportunity, win or lose. Subscribe, share with a friend who wants to invest smarter, and we will see you tomorrow. This podcast is curated by Patrick, but generated using AI voice synthesis of my voice using ElevenLabs. The primary reason to do this is I unfortunately don't have the time to be consistent with generating all the content and wanted to focus on creating consistent and regular episodes for all the themes that I enjoy, and I hope others do as well.